Welcome to WitTalk, a podcast by China Finance 40 Institute, a Beijing-based think tank. We have a strong track record of identifying major macroeconomic and policy trends in China. Tune in for independent-minded insights on China's economy, policy, markets, trade, and more. This episode is AI reproduced from the original conversation in Chinese. Hello, everyone, and welcome to WitTalk, a podcast produced by the CF40 Institute. Today, we're going to talk about Chinese manufacturing, mainly from an outside perspective. As China's manufacturing sector upgrades and expands, as our exports grow, and as Chinese manufacturing ventures abroad on an unprecedented scale, the way the rest of the world sees us is also shifting. Today, our guests are Liu Xiaochun, Vice President of the Shanghai Finance Institute, and Yu Fei, Research Associate at CF40. President Liu has done extensive research and has a wealth of first-hand experience talking with Chinese companies operating overseas. And Yu Fei has been involved in a whole series of research projects related to this topic in the first half of this year. In mid-May, she went on a field trip to Europe with a CF40 delegation and had many conversations and exchanges with Europeans on these very issues.
Hello everyone, I'm Liu Xiaochun, Vice President of the Shanghai Finance Institute.
Hi everyone, I'm Yu Fei, Research Associate at CF40.
Great to have you both here. President Liu, let me start with you. You've had extensive conversations with many Chinese companies operating overseas, and you've done deep field research in popular destinations like Southeast Asia. So let me ask you, how are these Chinese companies actually doing out there? And what kind of image do they have in the eyes of the locals?
I think what we're seeing is a really interesting new phenomenon. For Southeast Asia, their perception of China is also shifting. You ask how Chinese companies are doing. Some are really struggling, some are more optimistic, some are doing quite well. Otherwise, you wouldn't see so many companies going abroad, right? The key issue is that this outward push generates all sorts of reactions from the outside world. We hear a lot of positive things, but also plenty of negative ones, and people tend to feel the negative voices are louder. I think this has a lot to do with the particular characteristics of how Chinese companies are going global. Let me outline a few defining features. 1. You have companies from a single country spreading to every corner of the world. I don't think this has ever happened in history. Even when developed countries sent their enterprises abroad in the past, they were selective. They didn't just go everywhere. Chinese companies go practically everywhere, even to remote areas. I was in Shenzhen recently and met a company that goes to places so underdeveloped, they don't even have power grids. They bring our energy storage batteries there so families can light their homes so children can read at night. Then they move on to supporting computers and TVs. Then they start supplying small shops with batteries so they can run refrigerators and actually make money, and because it's hot there. So you see, they're going to the most far-flung places. This is historically unprecedented. That's the first thing. Second, we're sending virtually every industry abroad. Historically, in the 1980s and 1990s, developed countries moved labor-intensive industries to Southeast Asia, but not globally, and even within the so-called Third World, they were selective. After 2000, high-tech companies like Apple or brand-driven companies like Adidas set up supply chains in certain locations, but they didn't do the manufacturing themselves. They just positioned the chain there and let local producers handle it. They didn't bring every industry. But we're sending everything, from high-end to low-end, from infrastructure to restaurants, you name it, all from one country. Again, I don't think history has seen anything like this. Third, we're going out as entire industrial clusters. Earlier, I mentioned Apple. They lay out a supply chain, but what we're doing is moving whole industrial clusters. That means all the companies along the chain that produce a given product are Chinese companies relocating together. Why? There's an unspoken element here. We often talk about China's advantages, labor costs, labor efficiency, our willingness to work overtime. That's one side. We also have a complete industrial system, and our technology is advancing. Those are advantages too. But behind these advantages lies something even bigger, an unparalleled ability to coordinate across the supply chain. We talk about resilience, meaning the chain won't collapse. But I think this coordination capability is truly unmatched anywhere in the world. And because of this coordination capability, we can see something interesting. A few years ago, with the trade war and the pandemic, many multinationals adopted a China plus one strategy. But if you look closely, their China plus one is still essentially the Chinese supply chain, just relocated to another location, because they can't assemble an equally efficient supply chain in a new place. Only Chinese companies working together can build that kind of efficient chain. Initially, Chinese companies went abroad somewhat passively, driven by trade war and tariff. A shirt manufacturer would think, I'll go to Vietnam and make shirts there. Problem solved. But then they'd discover it doesn't work. Not just in terms of quality, efficiency and price. They get the fabric sorted only to find the thread doesn't work, the buttons and zippers don't work. It's actually more efficient and cheaper to import from China. At first they thought, okay, we'll just keep importing from China. But then they thought, brothers, why don't you all just come over too? So the whole chain moved. That's created another unprecedented feature, clustered, chain-wide, outward expansion. That's the third characteristic. The fourth characteristic, that related to the previous ones, is that we're not just diverse, we're huge in scale. This scale of outbound expansion has a truly seismic impact on smaller economies in particular. It's not like the old days when foreign investment trickled in gradually. When we show up in force. The local country's GDP suddenly jumps, its export figures suddenly jump. The impact is massive. Finally, and I think this is crucial and explains a lot of the difficulties our companies face, we are enterprises from a developing country going abroad. Let me emphasize why this matters. Traditionally, when we thought of foreign investment coming into China, we assumed those foreign companies were wealthier and more advanced than us. So when we courted foreign investment, we did everything we could to accommodate their needs. When I was doing credit work for foreign enterprises in the 1980s and 1990s, we bent over backwards to meet their requirements, respect their customs, adapt to their ways. Nobody insisted that they should respect our culture or our laws. But now, many experts advise our companies to respect local laws and local culture. I'm not saying that's wrong, but you have to ask, why do Chinese companies still run into so many problems even when they do respect those things? Over the past 100+ years, a new idiom has entered the Chinese language, worshipping everything foreign. This phrase didn't exist before. It emerged because we fell behind, and that created a psychology of deference. Many Chinese people still carry this mindset, this habitual reflex, seeing a foreigner and instinctively treating them as superior. But abroad, the same dynamic exists, especially in developing countries. They don't see China as a dominant power, nor as an advanced country. So from that angle, sometimes when we're being reasonable, when we're trying to be fair and talk things through, the local country doesn't interpret it as reasonableness, and they interpret it as weakness, as being easy to push around. So our companies face a lot of confusion and difficulty that stems from this dynamic. It's not necessarily that they haven't respected local culture, though of course there are cases where they haven't. I think this is a really important backdrop. This isn't really about discrimination per se. You see these dynamics elsewhere too, including in some parts of China. Additionally, for many small countries, because of the way we're going global, we think this is a good thing in the long run. It can help a developing country industrialize rapidly, especially small economies. In 2 or 3 years, they could be industrialized, their infrastructure modernized almost overnight. This was a dream that used to take decades or even a century to realize. But with China's involvement, it happens fast. You go to some developing countries now, and their internet speed is better than in developed countries. But we also have to recognize you may think you're bringing something wonderful, but in the short term, it can cause major disruption, even in Southeast Asia. When we went to Thailand, initially the conversations at the table were quite warm, but then someone said, when you came, we thought we'd be able to provide upstream and downstream services for your supply chain, but in the end it's all your own companies, nothing to do with us. So yes, you've boosted their GDP, boosted their exports and imports, but employment hasn't increased much, and there hasn't been much local industrial upgrading, because the entire chain is Chinese. In the short term, that's inevitably the case, right? But I think that's still just the surface. The deeper issue is this. When you arrive, if they already have a comparable domestic industry, you're a direct shock to that industry. They talked about how our automakers went to Thailand. Thailand was traditionally a production base for Japanese cars in Southeast Asia, for Japanese automakers. Now we've essentially crushed the entire Japanese auto presence there. For us, beating the Japanese competition is a win. But for the locals, even though those were Japanese brand cars, the supply chain was locally operated, local people were doing the work. You've actually crushed local businesses. That's a real immediate social problem. Our Mixue Bingcheng bubble tea shops went there too, and the local vendors couldn't compete. These things create social tensions, tensions so intense that the government in those countries might not be able to withstand the pressure. From that perspective, in the short term, of course, they're going to react strongly. And if they don't see you as strong, as powerful, then they have no reason to hold back. For Chinese companies, the commercial and operational difficulties are one thing. Those are their own problems to solve. But these bigger issues leave them feeling helpless, sometimes deeply wronged. That's the really tough part.
So we're seeing an outbound expansion of truly unprecedented scale across all industries practically everywhere. We feel we have our own reason to expand, and at the same time we're helping local communities. But along the way, it seems almost inevitable that we encounter significant resistance and pushback. I imagine this story has a mirror image in Europe as well. Yufei, you went to Europe recently. What specifically did you talk about? And actually, we also went to Europe around this time last year. Compared to last year, did you notice any changes in what the Europeans were saying?
The Europeans were quite focused on bilateral trade relations, the usual themes: dependence, overcapacity, the sense that China is producing all this stuff, we're not using it ourselves, we're not buying it ourselves, and we're just dumping it all on them to make money. That's one thing. Second, subsidies. The Europeans feel that China has provided substantial subsidies to many Chinese companies, and they lean toward viewing this as a form of unfair competition. Third, they feel there's an asymmetry in investment openness between China and Europe. Chinese companies coming to Europe face a very open environment, but European companies coming to China face all sorts of restrictive measures, joint venture requirements, technology transfer mandates, things like that. So they feel the playing field isn't level. One thing I heard more of this year that they brought up proactively was the RMB exchange rate. I hadn't heard them raise this so explicitly before, or at least not as much, but this time it felt like everyone was starting to focus on it, whether we're deliberately keeping our exchange rate at an artificially low level to boost exports. These are the main concerns Europe has about China on the bilateral trade front. They raised these questions in the meetings, and we responded based on our fairly solid research.
So after all these conversations with the Europeans, what's your overall takeaway? How did it feel?
I really felt their anxiety. It's genuine, it's palpable. Facing the rapid development of Chinese manufacturing, they worry about whether they can protect domestic employment, whether this year's economic growth targets can be met, whether they can keep their economies and societies stable. If too much manufacturing slips away, if they run large deficits, that genuinely impacts domestic economic conditions. So this anxiety isn't something they can easily resolve through their own adjustments. But the problems are real. As a result, China-Europe trade relations are becoming increasingly tense. It feels like we're on the edge of a cliff. If relations deteriorate further, it could spiral into a trade war, which nobody wants to see. So this bilateral trade tension is something that really demands serious attention.
Right, and we've recently seen a flurry of moves from Europe, like the special meeting on China they convened on May 29th, where they proposed new trade measures targeting China. And as you mentioned, issues like employment and industry. Maybe we can't just go to them and explain the economic logic. It's not that they don't understand it. They probably do, but they can't accept it. It's not purely an economic issue. It's more of a political and social one.
Exactly. Industrial growth and employment growth are relatively long-term issues. But for many European politicians, the immediate pressure is maintaining economic and social stability. So it's not just about the economics. We can talk about what the data shows, how the economic math works out, but for them, there's a political logic operating too. If we don't pick up on these political concerns, it can feel like both sides are talking past each other, not on the same wavelength.
So on one hand, some of Europe's anxiety is understandable. On the other hand, we probably need to demonstrate a genuine willingness to solve problems.
Right, especially around their concerns that may be more political in nature. We probably need to get better at understanding how to engage with them on that level.
I think what you've both described are very typical stories from China's manufacturing growth and global expansion. The outside world still struggles to quickly adapt to and accept our powerful manufacturing and export capacity. They still view us through certain stereotypes. At the same time, the competitiveness of Chinese manufacturing amplifies their own understandable anxieties about their own development, and this leads them to try to explain our progress using their own frameworks. As Yufei mentioned, I feel like I keep hearing three explanations: overcapacity, subsidies, and the RMB exchange rate. So let's take these one by one and see if they actually hold water. First, overcapacity. The foreign narrative is, why does China export so much? Why do Chinese companies go abroad? Because you produce all this stuff domestically and nobody buys it, yet you keep directing resources into manufacturing instead of elsewhere. So you've created overinvestment in manufacturing, which leads to overcapacity. What do you two make of this argument?
On the overcapacity question, the external view is that China is selling them a huge volume of goods, and they feel like they're just buying from us, while China doesn't import much from them. So the story goes, you have overcapacity, you don't consume it yourselves, so you dump it all on us. The so-called new three, EVs, batteries, solar, get the most flack. But from what we observed in Europe, there genuinely is huge demand for these products. They're pushing energy transition, especially after the Russia-Ukraine conflict made them realize they need to take energy seriously, become more self-sufficient, avoid overdependence. Plus, with the Middle East situation pushing oil prices up, their green transition goals, these are things they themselves want to pursue. But then they realize, where can I buy this stuff cheapest? Wind, solar, batteries. Only China sells products with this level of quality, advanced technology, and low prices. So, of course, they buy from China. And for Chinese companies, if the demand is there, naturally we're going to produce for it. So you can't just reduce it to China can't sell its stuff, so it has to dump it on Europe. Supply and demand work both ways.
President Liu, what's your view?
You can't talk about overcapacity from a narrow, localized perspective. If we say a country only has so much demand, so you should only produce that much and not sell abroad, then we might as well not talk about international trade at all. We wouldn't need Ricardo's theory of comparative advantage. The very existence of trade proves there's demand. So whether there's overcapacity can't be judged purely by one country's domestic demand for a particular product. That's the first point. Second, let's not kid ourselves. When the West wanted China to open its markets, nobody talked about overcapacity then. It was all about free markets and competition. From where I stand now, that's a double standard. Third, in a sense, throughout decades of globalization, Western countries had a certain vision, a kind of hierarchical thinking. They'd keep moving up the industrial ladder, and the third world would handle the dirty work. To some degree, you could even say, and some of our own experts have said this, that we should learn from America, offload the low-end, labor-intensive stuff, and focus on design, supply chain orchestration, and finance at the very top, making the most money with the least effort. That was the plan. But they didn't account for the fact that they still have what we might call vulnerable populations at home who also need to make a living. That's how you get America's rednecks. So, to some extent, this is a problem of their own making, not something we deliberately engineered. Fourth, throughout the earlier decades of globalization, especially in manufacturing, the West was basically earning monopoly rents on technology. They'd produce equipment very slowly and charge exorbitant prices. Take green energy and environmental protection. The West proposed these ideas, then shifted the pressure onto developing countries, especially China. At the time, because they'd already offloaded their low-end industries, their air was relatively cleaner. When they started championing environmental causes, they already had the technology pipeline in motion. They assumed their technology would always stay ahead. They'd demand you go green, you'd have to buy their equipment, and they'd designed a whole financing scheme around it, how you'd borrow money, structure the financing, and ultimately buy their equipment. That was the playbook. But they never expected we'd commit so seriously and that our technology would advance so rapidly, mobilizing national resources to solve the problem. In the end, China genuinely delivered, while some Western countries simply couldn't keep up. That's created a comparative advantage for China, even if you want to do it now. Unless you completely block Chinese products and try to do it entirely on your own, you simply can't. The cost, the technology, the efficiency, it's impossible. China might get it done in 6 months, so what can you do? So it's not that we have overcapacity. It's that you have demand you can't fulfill yourselves, and we can meet it on the spot. If you look at it this way, all the talk about industrial policy, I could flip it around and say, you demanded China go green, China did it, and now you're calling it industrial policy. I don't think their arguments hold up.
Of course, our goal isn't to argue who's right and who's wrong, but let's continue. We talked about overcapacity. Now let's talk about the subsidy narrative. I'm sure everyone has seen the recent OECD report, once again dragging Chinese subsidies into the spotlight. It claims that over the past 20 years, China has provided subsidies to its enterprises that are several times what Western companies receive, mainly in the form of low-interest loans. We've actually written our own reports rebutting this. Isn't this a pretty tired story by now?
Yeah, we wrote about this a few years ago. Looking at listed company data, we found that since 2023, Chinese government subsidies to manufacturing enterprises have actually been on a declining trend. And the recent CF40 brief that responded to the OECD report, the OECD used a relatively small sample of enterprises and then extrapolated to claim China provides massive subsidies. But when we looked at the full universe of listed companies, we found the same pattern. Subsidies are declining. And these subsidies were never exclusive to domestic firms. European companies operating in China, like automakers, also received them. When subsidies were distributed, nobody said, "Sorry, Chinese companies only." Everyone who qualified got them.
Here's another thing. China's new 3, solar panels, for instance, weren't created by Chinese subsidies. They were created by European subsidies. Chinese companies started making solar panels because Europe announced they were restructuring their energy mix, phasing out coal and ramping up solar, and they introduced substantial subsidy policies for solar. It was those European subsidies that prompted many Chinese private enterprises to start production. We didn't have subsidies here. In fact, we bore the pollution from manufacturing those panels. Not only did we not receive subsidies, we absorbed the environmental cost. Many companies that started production back then, when the technology was brand new and costs were very high, they were basically making money off European subsidies. So for Europe to turn around now and accuse us, if I were one of those entrepreneurs, I'd feel deeply wronged. And on top of that, as Yufei mentioned, they've crunched the numbers and our overall subsidies are declining. In certain sectors, there were no subsidies at all in the early stages. Only later, when we started thinking about green transition, did some subsidies appear. But even then, as I said, they weren't exclusive. If you produced in China, you got them, regardless of nationality, and they were phased out fairly quickly. Also, in this process, it's not just that we didn't subsidize heavily. It's that in pursuing green transition and pollution control, once we set the standards, many small companies went bankrupt overnight because they couldn't meet emissions requirements. So we actually bore enormous costs, call it losses, if you will, with many enterprises, especially SMEs, shutting down because they couldn't comply.
So to quickly summarise, first, subsidies didn't start with us. Second, we've largely phased them out, and we didn't just subsidise ourselves, we subsidised others too. Third, in the process of going global and exporting, we've borne plenty of losses and costs ourselves. Now, beyond overcapacity and subsidies, the third explanation I keep hearing for Chinese manufacturing competitiveness is the so-called undervalued RMB. Because the RMB is undervalued, Chinese exports are artificially cheaper and imports into China are artificially more expensive. I've seen articles citing data that over the past 4 years, China's trade surplus has surged, while the RMB's real effective exchange rate has depreciated 15%. The external view is, doesn't this violate market principles? Normally, a surplus country's currency should appreciate, so there must be some manipulation going on. What do you think?
I think exchange rates can't be reduced to a simple surplus equals appreciation, deficit equals depreciation equation. Exchange rates are shaped by a complex mix of factors, domestic economic shifts, relative changes in the international economy, and short-term fluctuations in capital flows and supply-demand dynamics in currency markets. An exchange rate isn't just a simple external price of a currency.
We've done relevant research, and I completely agree with President Liu. The exchange rate is a comprehensive equilibrium outcome. It's not as simple as two countries trade. I have a surplus with you, so my currency must appreciate against yours.
It's not that static.
Exactly, it's an equilibrium. And we also looked at Europe's import price indices, whether they're importing from us, from Japan, or from South Korea. The price trends are broadly similar. We're not on some uniquely steep downward price trajectory. Beyond that, looking at exchange rates over the period when they complain about surging surpluses, our currency has actually moved both up and down. And recently, the RMB has been appreciating. We're at around 7.8 to the euro now. The exchange rate alone is very hard-pressed to explain the full bilateral trade picture.
So we're not dumping cheap goods on Europe. The RMB hasn't actually depreciated that much. And on top of that, as we discussed, there are still these structural issues at play.
The surplus is just a surface phenomenon right now. I think what's really happening is that these politicians have already seen the writing on the wall. If things continue this way, Europe's once vaunted advanced industrial capacity will keep eroding. So now they want to stop it. But you can't tell China to just stop, to go back to the 1990s. That's impossible. But here's the thing, that, as I mentioned earlier, China's supply chain coordination capability is something they simply can't compete against. Even if they have the technology, it doesn't matter. I think that's the fundamental issue.
On the surplus question, I want to bring Yu Fei back in, because our recent series of reports actually surprised and impressed me. We approached the huge surplus from the angle of the real estate cycle, and our report suggested this is a perspective that the outside world hasn't fully grasped or appreciated. Can you elaborate?
We went to Europe well prepared with our research, and honestly, it was very effective. Let me share the core argument from this new paper. Not mine, but our team's. Everything we've discussed so far has been more structural, focused on energy transition and so on, but you can also flip the lens. A really important lens for understanding the Chinese economy in recent years is how the real estate adjustment impacts the macroeconomy, including the trade surplus. We compared many historical episodes of real estate crises and what happened to trade surpluses afterward. What we found is, when the real estate market starts to decline, a rising surplus is a very natural outcome. Many countries have experienced this. At its core, a country's surplus rises when total savings exceed total investment. A real estate adjustment affects both sides of that equation, and what we see is that investment falls faster than savings, so the surplus goes up. But this is just a normal post-crisis adjustment process. In terms of magnitude, we haven't exceeded the typical historical pattern. The thing is, many external observers haven't specifically looked at it from this angle, understanding China's current surplus through the lens of the real estate cycle.
But this also reminds me of Japan. When Japan's property bubble burst, their credit system also collapsed. In some ways, their situation was even worse than ours, yet their surplus didn't seem to expand rapidly at the time, did it?
When we made this argument in Europe, the Europeans actually raised the same point. They said when Japan's bubble burst, credit contracted sharply, investment contracted sharply, but China hasn't. You're still doing okay, and your investment is flowing massively into manufacturing. That's exactly what makes Europe so uncomfortable. But here's the thing. The fact that China's credit and investment didn't collapse is precisely what has contained the surplus. If our credit had collapsed and investment had collapsed alongside it, the surplus might be even larger, and the resulting demand contraction would be something the whole world would find even harder to handle.
So we're already doing our best to adjust. And speaking of real estate, it also makes me think about how much the outside world has been talking about China's so-called excess savings in recent years. It's closely tied to the domestic demand and export narrative. Because the property market is sluggish, people are simply spending less, so we rely more on exports. So the external argument is China should find ways to absorb this so-called excess savings, especially household savings, and then the other problems would resolve themselves. What do you two think?
I think economists like to say this kind of thing, but every country has its own circumstances, its own culture. If you want Chinese people's savings rate to come down, I think you might need another 2 or 3 generations. I don't know about the next generation.
The next generation is even stingier.
So, first of all, the idea that you can simply get Chinese households to save less and consume more purely as a numerical solution, I don't think that's viable. Second, the notion that we should use that money to absorb our own production, that's also unrealistic. What we produce now supplies the entire world. The real question is, does the world need the production capacity China currently provides? That's what matters most. We're facing a global climate crisis. If we want to solve it quickly, we should be encouraging development like China's, encouraging Chinese-style supply chains to spread globally and accelerate solutions, not calling it overcapacity. And of course, it doesn't have to be produced in China. Maybe other countries should quickly learn to produce as well. That would be a real solution. Not saying, you've made all these wind turbine blades, now every Chinese person should buy one and play with it at home. That's absurd.
I think a lot of times when they tell us to boost consumption, what they really mean is your government needs to take actions that will ease our current anxiety. But if you look at the data, having gone through industrialization, our consumption rate has actually been trending upward in recent years. It's in a relatively healthy state. The problem is, this kind of gradual recovery doesn't do anything to alleviate the external world's immediate emotional state.
There's also the question of speed versus structure in consumption. As I said, an increase in consumption doesn't equal an increase in consumption of manufactured goods. While manufactured goods consumption can theoretically be unlimited within a given time and space, it's finite, and household consumption, beyond big-ticket items like houses and cars, is mostly everyday goods. That's very different from what they're afraid of. Those green transition wind turbine blades I mentioned, those have to be deployed overseas.
It's an even more fundamentally difficult problem to solve than just the speed of consumption changes that Yufei mentioned.
Given the climate crisis we face, given the green transition needs of our entire planet, first of all, there is no overcapacity. Second, even if China stopped producing, it would only be solved if you could produce it yourself. The problem is, you can't. So, as I said, this isn't a real solution to the problem. And of course, as Yufei mentioned, our consumption increase is also a gradual process.
I wonder, do many foreigners still hold that stereotype of Chinese goods as low-end products? Maybe we don't hear it as much anymore, but I suspect that perception still lingers somewhere. Yet in the past couple of years, more and more foreigners seem to be noticing, wait, Chinese companies are now making things they never used to make, and they're getting better and better. But on the flip side, you're still making all those low-end products you always made. Normally, as you move up the value chain, you're supposed to offload the lower end to other countries. Then there's supposed to be a process of industrial transfer and succession.
Comparative advantage, as we mentioned.
Right? It should follow comparative advantage. That's what the world sees as normal. But now it seems like China is excelling at the high end while not letting go of the low end at all. From the outside perspective, that's actually pretty terrifying.
For many other countries, they look at China and think, you're making high-end products like cars now, and you're still making textiles and toys. We still have to buy everything from you. So they feel like Chinese manufacturing has this tendency to monopolize the entire world's supply. But when we break it down, I think the fundamental reason is that there's still a development gradient within China itself. China is huge. It's not the same everywhere. We can look at a national per capita GDP figure, but if you actually go to different regions, we are like my hometown in Heilongjiang, which was a great place decades ago, our manufacturing capacity there is very different from the southeastern coastal areas or Guangdong. The comparative advantages aren't the same. Because China is so big internally, we're essentially a flying geese pattern all by ourselves. Each region can be its own goose. Industries can transfer domestically, from the southeast coast to the central regions, then to the west. When you look at development levels across different regions, you realize there are still huge swaths of China's population at development levels comparable to Vietnam or to Malaysia. At those development levels, it's perfectly normal to still be doing lower-end manufacturing, like textiles. And it's not that we don't transfer any production abroad at all. We've seen greenfield investment into Vietnam, into Thailand, and Southeast Asia. We are setting up factories there. So overall, it comes down to development levels. From the data, a country's economic development level and the share of high-end manufacturing are positively correlated. Since we have a gradient internally, transfer between gradients happens naturally. Another dimension is our sheer scale. We have economies of scale and coordination advantages. Our domestic market is enormous. With a big market and complete supply chains, our production costs are naturally very low. Beyond that, in terms of population, the segment of our population at a development level similar to Vietnam is roughly the same size as Vietnam's entire population. So internally, we contain the equivalent of many countries. We can fit most of Japan, several Mexico-sized economies, Malaysia-sized economies, plus a few Vietnams and Thailands. We're an enormously large economic entity, which is why we can accommodate all these industries simultaneously. And finally, China has just developed too fast. Many Europeans probably thought a few years ago, I'll never see a Chinese car in front of me, but a few years later our cars are driving right up to them. The psychological shock is immense.
The psychological impact is huge, but there's another issue here. This question of, you can already make such great products, why don't you transfer the lower-end stuff out? It's not a simple, voluntary transfer, because we did once have the idea, maybe we should move some labour-intensive, low-end industries out, along with highly polluting ones, just like how Western countries in the 1970s, 80s and 90s moved their labour-intensive industries to Southeast Asia, giving us the four Asian tigers. The problem is that transfer worked because their own wages were rising, welfare costs were rising, so they lost competitiveness. Individual companies started moving out first, discovered that labour costs were lower here, the products were the same quality, and selling them back was actually cheaper. So mass relocation followed and their domestic industries moved up the value chain. Western countries had the demand, and the receiving end could absorb the low-end industries, meeting the required volume, quality and cost targets.
The opposite of what you described about China's current situation.
It's not that I don't want to transfer out.
It's that other places can't absorb it.
It's like Adidas and Nike. They originally invested in China, then moved production lines to Vietnam, to Bangladesh. The problem is, after moving, they end up coming back. The efficiency, the cost, the quality, they can't meet the requirements. You still have to come back. So this is what I was saying. Our supply chain capability is truly unprecedented. The coordination, the comprehensive capability, it's unmatched. Some people think China is unwilling to transfer production out. But one reason is our internal gradient, as Yufei said. The other is, even if you transfer out, you'll end up coming back. Look at how many German companies, BASF and others, are now setting up production in China. It's not that we begged them to come, they came on their own.
So to sum up, the outside world tells a story of a global flying geese pattern. But what we're saying is that China itself is a massive, fast-growing, extraordinarily comprehensive flying geese formation all on its own. And whether from a geopolitical perspective or any other angle, you might demand that we transfer production out. But I, as a business, wouldn't even make that choice. Because at the end of the day, I care about efficiency and quality. We've talked about how China is this vast, sweeping, flying geese formation. I think that was mostly about our export side. But I also want to circle back to Chinese companies going abroad. Our outbound expansion is truly on a breathtaking scale. As we said, we're developing too fast, our scale is too large, and the outside world can't absorb it. To borrow an analogy Yufei used on the podcast last year, what do Chinese companies look like in the eyes of Thais right now? It's like Chinese New Year. You just woke up and you find your house crammed with relatives you've hardly met, barging into your kitchen, grabbing your pots and pans, insisting on cooking you a meal. Chinese companies are going abroad too fast and too massively, to the point where others just can't take it. Of course, that was last year. President Liu, do you think Chinese companies going abroad are still in that mode? Have their strategies adjusted at all to make locals a bit more able to bear it?
I think this needs time. It's a process. As I said, the supply chain coordination capability is already there, and in the short term it's going to exert pressure, enormous pressure on these countries and economies. But you also have to consider, once our companies are there, once the technology is there, once those supply chains settle in, give it 3 years, 5 years, I think imperceptibly they will lift the locals up, including technology and everything else. Because the companies themselves didn't initially plan to go out this way. They just discovered after going out that this is what works best. But if you tell all the Chinese companies to go home, The local economies would just revert to their previous level. That's exactly what we found in Thailand. This love-hate dynamic is the crux of it. They can't afford to let you all leave either. If you leave, they're back to square one. Having you here creates pressure, but at least these cars are being made in their country now. Even if Chinese people are doing the manufacturing, the production is happening there. The conditions for production now exist there. And I imagine this is speculative. There's no empirical evidence yet. But I think in 5, 10, 20 years, yes, many Chinese will still be running businesses abroad. But these places, especially in the global south, as they follow you into industrialization, as their infrastructure improves, they'll develop on their own. By then, the share of Chinese enterprises in their overall economy will decline, and it won't feel the same to them anymore. This is just my imagination, of course, but I think there's an evolutionary process here. You can't say, come invest, but don't do it that way. That's impossible. If I come to invest, I'm going to occupy part of your market. Just like when we actively courted foreign investment, we were inviting you to take part of our market. You can't invite foreign investment and then not let them occupy the market. There's an inherent contradiction, and there's no easy solution. You want to satisfy the existing interest groups, but you also want the whole country to progress. It's genuinely a difficult problem.
Also, many local countries now compare China to what Japan and South Korea did back in the day. What do you make of that comparison?
I think that's also a narrative. It's like the process I described earlier. When Japanese companies first went in, those countries had nothing. No auto industry. But they already viewed Japan as a strong, advanced nation, so they respected them, accommodated them, and at that time it was a blank slate. The Japanese set up factories, and initially they brought their own management and technical staff. Over time, they realized the cost of sending people from Japan was high, so they gradually localized. Second, there's a real difference. When Japan came to Thailand, they came because they saw opportunity. The Southeast Asian market, plus proximity to rubber production, since cars drive demand for rubber, they could organize a local rubber supply chain. So the locals felt immediate benefits. Industry arrived, supply chains arrived, there were jobs, and their rubber had a market. That's not to say there was no cultural friction. There absolutely was. But it played out over 30 plus years. And we have to give credit to Japanese companies. When they decided to localize, they had a whole system for gradually training locals. After 30 years, they'd gotten used to the whole setup, integrated. Essentially become part of the fabric. So now when they compare that to the shock of you just arriving, the contrast is incredibly stark. That's why I said earlier, give it 10, 20 years, once Chinese companies have gradually integrated into local communities the same way, the feeling will probably fade.
If we use the experience of Japan and South Korea as a reference point, standing where we are now, what new challenges or problems might Chinese overseas companies face next, things they're not used to dealing with?
From the enterprise perspective, there are several dimensions. One, we genuinely need to understand the local ecosystem, local culture, local laws. Respecting them, complying with them, that's one side. But there are also things you don't need to go out of your way to respect. Corruption, for example, you don't need to adapt to that, though you do need to navigate it. Another thing, which I mentioned earlier, is how to handle the fact that locals don't see you as a company from a developed, advanced country, and don't see you as a person that way either.
Do you think that can change?
It takes time, there's no rushing it, and it's not just up to the companies, the country needs to become stronger too. Some Chinese people are naturally more low-key, less inclined to confront others directly. On one hand, we need diplomatic and consular protection measures. On the other, we probably need to use all sorts of other tools to protect our overseas assets, because we're just too big. I think that's really important.
That's an incredibly complex issue. It requires wisdom, experience, courage, and action at the enterprise level too.
At the enterprise level, at the national level, and probably at the societal level too, industry associations, for instance. Look at what we have here, the American Chamber of Commerce in China, the Japanese Chamber of Commerce. Should we be setting up similar organizations in those countries? Organizations that can integrate into local high society, serve as a platform for having a voice. These are things we need to gradually push forward. The state needs to drive this.
Understood. Yufei, when you were talking to the Europeans, did you get any related impressions?
I feel like Europe both wants Chinese technology and fears Chinese investment. They worry about national security, economic security, supply chain security. There are all these other considerations, but at the same time, they can see that in many areas, Chinese technology is pulling ahead and they need it. Battery technology, for example. They do want it. So overall, Europe's attitude toward Chinese investment is this very tangled, ambivalent state. And it's not just what we discussed. The EU as a platform, different directorates general, different member states have vastly different interests. Hungary, for example, really welcomes our investment. We've set up battery factories there, and they're very welcoming. But other countries are far less enthusiastic. So the EU as a whole, I feel, has this consistently ambivalent, conflicted attitude toward Chinese investment. But given that other issues are even harder to resolve, perhaps on the investment front, designing some kind of arrangement that satisfies them and that we can agree to, that could, in theory, be a relatively good way to absorb some of the surplus. But how to design such an investment agreement or mechanism is very difficult. Still, it seems like the most promising entry point, because everything else is even harder to solve.
Related to that, we've been talking about what we can do, what adjustments we can make, but I'm wondering, even if we make these adjustments, whether in Southeast Asia or Europe, will they actually be happy? For example, whether it's local employment, industrial upgrading, economic development, if Chinese companies do better, integrate more into local communities, and if in Europe we reach some kind of agreement. Could it be that they end up facing new problems and challenges? After we change, if they don't make adjustments too, can they adapt to our changes?
I think it'll vary. Relatively speaking, for Southeast Asian countries, if they feel the pressure from you isn't overwhelming and overall it benefits them, then the current tensions around government and social pressure are relatively manageable. And there's another thing. Historically in this region, China has always been the big power. They've never had a psychological burden about that. But when Western countries engage with Asian countries, psychologically, they haven't adapted yet. That's a very hard phenomenon to change. It'll take time.
So we've been talking about whether if we adjust our approach to outbound expansion and manufacturing exports, the outside world can adapt, can acknowledge it. I think this flip side also holds at the macro level. We spent a lot of time earlier talking about how the real estate adjustment might be driving our large surplus, a factor the outside world may not fully understand. But at least our assessment now is that China's real estate adjustment may have reached or be approaching its end, and based on that, we expect the surplus to narrow. So the next question brings us right back to where we started. If our surplus shrinks, will the world be happy?
The surplus is from our perspective, but what the outside world cares about is bilateral relationships. Our overall surplus narrowing doesn't necessarily mean the surplus structure with Europe, for example, reverses, because the supply-demand dynamics are what they are. They need these things, so it's not guaranteed that even if the RMB appreciates, we boost consumption, we reduce subsidies. Even if the property market adjustment completes, the surplus structure might still persist. A lot of European thinking is they need to see China take certain actions, meet their demands. But at the core, what's really driving this is their anxiety about their own economic development, their inability to compete, and mobilizing internally is very difficult for them.
The key is still, they need to find ways to progress themselves. That's what matters most.
So in one sentence, if China makes changes but the outside world doesn't keep pace, doesn't make corresponding efforts and adjustments, then they may face a new set of problems and frustrations. Speaking of our own adjustments, I think there's another really important factor, AI. What does the development of AI mean for Chinese manufacturing? And if Chinese manufacturing increasingly adopts AI, what does that mean for the world?
Right now, AI hasn't really entered the production sphere yet. If we can genuinely apply it to industrial production in similar areas, we might see another wave of high growth. That could temporarily reduce some of the so-called surplus, because our domestic investment would pick up. But the outside world might become even more afraid. This might connect to another issue. I've been travelling quite a bit lately, and what I'm sensing is that we're putting enormous effort into new productive forces. Local governments are investing heavily in this area. Progress is fast. AI is advancing quickly. But what you feel on the ground is a tale of two worlds, the so-called traditional industries and these new productive forces, these emerging industries, it's like they're two separate things with no connection between them. That's why you get this ice and fire sensation, this split feeling about the economy. When you look at the new economy, it's booming. Lots of money pouring in. Everything's exciting. But when you look at the traditional sector, it feels cold. That's a big problem right now. When we've made technological progress, when we've caught up to or even matched the US in some areas, that's necessary, that's important. But the next question is, once the technology is advanced, how do you turn it into real productivity, real momentum? We haven't seen that yet. But I think we might be at a turning point now, and I think CF40's research has touched on this too. We're at a turning point. What is this turning point? I think the direction tech people have been exploring might be wrong. Replacing this, replacing that. I think they haven't found the real direction yet. If it's not about AI simply coming in and replacing article writers or things like that, I don't think that alone can drive a whole investment cycle. Only when new materials, new digital technologies and new AI come together to reshape existing industries will we see a new wave of investment, a new wave of demand, and the economy will truly begin its transformation. Only then can these so-called new productive forces become real economic engines. It's like how real estate used to work. When real estate took off, it pulled up cement, steel, glass, those industries, their supply chains, the whole economy, and then we had more money. We consumed more. Same with automobiles, steel, rubber, glass. A whole chain of industries gets activated. Right now, these new productive forces haven't played that role yet. They haven't driven the broader economy. So as I said, we need to bring all these technologies, including new materials, into traditional industries, not separate them into sunset and sunrise sectors, because many so-called traditional industries are actually perpetual industries. If new technology truly enters them, only then can it become new momentum. Can it drive a new investment wave? So when some economists say we'll never see high growth rates again, I think it's possible, but only if this integration happens can growth be reignited. And that might also help resolve some of the surplus problems, some of the production issues. But it would also mean pulling even further ahead of everyone else.
The real economy is one story, AI is another story. But what we're hoping to see in the future is them becoming one integrated story, where a rising tide lifts all boats. Well, we've covered an enormous amount of ground today. Starting from conversations with Europeans, we've discussed many outside perceptions of us, offered some explanations, some responses. The whole point of this episode was really to foster more understanding, not just hoping the outside world understands us better, but also acknowledging and facing the contradictions head on and seeing what we can do better.
And as we said at the beginning, it's not just about the trade imbalance or surplus with Europe. We run surpluses with many economies around the world. Overall, our savings still exceed our investment. So for China, as an economy, managing our surplus well is a really important issue, because we're no longer the relatively small economy we once were. We're a massive economic entity now. Our surplus has a significant impact on our trading partners around the world.
Not just Europe, as we mentioned.
Right, including Southeast Asia and other regions. These are all bilateral trade relationships we need to nurture and maintain. So only by getting policy right can we sustain good cooperative relationships with our trading partners and ease the overall trade tensions. Specifically, things we've already talked about, expanding consumption. That's a fairly basic consensus, including the RMB exchange rate. We think some appreciation is feasible. These are all ways of demonstrating sincerity in addressing the trade imbalance.
In summary, we need to take external concerns seriously and make changes ourselves. On one hand, this can help dissipate some of the external misunderstanding or resentment. On the other, it's good for our own better, more sustainable development as we go global.
I think another really important thing is mutual communication. If we're just trading slogans at a relatively abstract level, that does absolutely nothing to ease the current tensions, because we feel like we're on the edge of a cliff right now. Any statement or action from either side could be interpreted as an aggressive escalation. So a better approach, and I think this is what we tried to do on this trip, is to do fact-based research, have open and honest exchanges and discussions. That way we can better understand what the other side is really thinking. And I think you can gain a lot of valuable insights from these exchanges and then further explore why certain problems have developed the way they have and what policy solutions might exist.
President Liu, any final thoughts?
I wonder if we can turn the slogans into habits of thought and behaviour. That is, viewing all the world's peoples with an equal gaze. Adopt a mindset of equality, and then consider what should be done. That might be more important. From China's perspective, as a country, as enterprises, that we need to do our best, keep improving ourselves. But we should also approach the world with an attitude of equality, neither inferior nor arrogant, mutual understanding, focusing on doing our own work well. I think that's what matters most.
All right, I think we've covered plenty today. We've really touched on so many topics, and honestly, I found it incredibly rewarding to listen to. It goes beyond research or anecdotes. It's really about psychology, about how you view the work you're doing, how you face the misunderstandings that arise, how you walk into the world with dignity and without arrogance or servility.
From a research perspective, we study what we call economic problems, but really these are phenomena of human society. You can't just explain or define them through some theoretical framework or concept. Understanding, I think, also means seeing both the dark side and the bright side.
That's about all we have time for today. The relevant reports will be in the show notes for your reference. Thanks for listening, and we'll see you next time.